Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the MarketSite studio, we have Thomas Smale, CEO of FE International, to discuss why the M&A surge in the tech sector is coming to the marketplace. It's great to have you with us, Thomas. Welcome to TradeTalks.
Thanks so much.
Tell us about some of the actions and inactions that you expect to see that's going to be the catalyst for this surge.
Yeah, so I think firstly we've already seen some of the surge. So this year we're seeing more activity than we've ever seen before. We've been in the industry for 13 years and the surge is just continuing. So firstly there's quite a few different factors that go into it. Interest rates rising, so Fed continuously pushing up rates has meant that some companies are struggling to raise money at the moment. They don't have access to bank capital. So in those cases, some of those companies are opting to sell. Exactly the same side, if you're an acquirer or you're looking to buy a business, some of those businesses are realizing that those companies might be forced to sell or perhaps coming a bit more realistic with their expectations. So there's a little bit more activity where buyers are getting closer to sellers in terms of what they want to sell for, which is driving a lot of activity at the moment.
What about the impact of Silicon Valley Bank on the space?
Yeah, so I think firstly, we've had 3 months now, 3 or 4 months post Silicon Valley Bank, so that things have calmed down a little bit. Post SVB, I think a lot of founders got scared or worried for a while. A lot had quite preferential deals with SVB where they had access to capital. Maybe that was like personal, like a mortgage, or maybe that was just funding for their business. So some of those companies were either forced to sell or they're forced to completely pivot their strategy because they've no longer been able to access that capital. I think other banks have somewhat followed suit. So we've seen some who are getting a little bit more nervous about lending, which has meant that some of the activity or more of the activity has come from buyers who already have cash on hand. So if you look at the wider industry, there's something like $4 trillion of dry powder out there with private equity firms at the moment. So even without debt, there's still a lot of deals that can happen.
So who do you think is going to be leading the next round of buying?
So at the moment, we're seeing a big surge in private equity firms acquiring.
Right.
Over $4 trillion in dry powder. These firms, the very nature of their business, they have to deploy that capital. So for example, recently we saw a $35 million transaction for a business called Thrivecart. The acquirer was a US-based private equity fund called LTV Fund, who have over $100 million assets under management. So we see lots of private equity firms in that, say, $100 million to $1 billion assets under management or cash to deploy. They're doing a lot of deals right now.
What about the Microsoft and Apples of the world? They have a lot of cash on their balance sheets.
They definitely do, but I would say, at least from what we've seen, and we're speaking to these companies every single day, we have 150 people across the world, they're constantly having these conversations. What we're seeing is that the bigger public companies, like Apple, like Microsoft, for example, are still acquiring, but they are being a little bit more cautious about what they're looking to acquire. Maybe they want it to be bigger than before. So it might be they want to only buy businesses with revenue above $100 million. But 2 years ago, they might have looked something above, say, $10 million. So still looking, but we're definitely seeing more activity from those private equity firms. The public companies are being a little bit more selective. And I think that's really just going to continue for the next couple of years.
So would you say that big tech's strategy of growth through acquisition is winding down a bit?
Definitely to an extent. I think for the public companies, yes and no. I think no, because if you look at the private equity firms, growth through acquisition for them is often buying businesses which are synergistic with their existing portfolio. So if you're a private equity firm and you have $1 billion, you're not just deploying capital to buy one business, you're probably buying 5 or 10. So they will buy to grow their existing portfolio. If you're a larger public company, I think growth through acquisition is more difficult at the moment. That's definitely slowing down, but hopefully will come back as part of their strategy in future years.
Tell us more about FE International. What verticals are you focused on?
Yeah, so we're a lower middle market technology M&A firm. We work with software businesses, SaaS companies, so software as a service, digital media, publishing businesses, digital service businesses, and we very much have an international reach, so we work with clients all over the world.
All right, appreciate the insight, Thomas. Thanks for joining us on Trade Talks.
Thanks so much.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.